The Fed Chair Jerome Powell speaks today and announces that the Fed is going to raise the federal funds rate again by 0.75 basis points while also reducing their balance sheet. He also goes over the state of the economy and what the Fed intends to do in order to combat inflation. Let's go ahead and get to all that right after this. Welcome back after the break, everybody. Mike Petras here, your star realtor of Star and the Treasure Valley. And as mentioned during the intro, yes, Jerome Powell, the Fed chair, did speak today this afternoon at his press conference and officially announced that the Fed is going to raise the federal funds rate again by 0.75 basis points or 0.75% while reducing their balance sheet.
Today, the FOMC raised its policy interest rate by 0.75 of a percentage point, and we anticipate that ongoing increases will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet.
So what does that mean? How is this going to overall trickle maybe to mortgage interest rates and even affect the housing community? So let's go ahead. Let's dive into that information. Let's see what he said. Also see what he said about some of the stats and what they intend to do to get more aggressive coming along, and can they avoid a recession? So let's start off with one of the first things Jerome Powell said this afternoon, and that is that the United States needs softer labor market conditions.
Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions.
So what he was saying is that the labor market still seems to be on the good side. He is sticking by that stance. And basically he's saying right now that there's much more vacancies than the available workers out there. Basically 2-to-1 ratio of the jobs that are available compared to the people that are actually filling them. But he only said that only modest data recently is showing that the overall labor market is softening. Now, of course, that's debatable. If you read certain articles, you can see that people seem to be getting laid off, especially over in like the tech side of the workforce. So we'll just have to continue to watch those numbers and see what's really kind of going on with employment. But they do project that unemployment will hit 4.4% next year, which kind of more or less indicates that a recession is going to be around the corner, because of course we know that as people start losing their jobs, and the labor market softens, it really does affect things as it moves forward and can tote us into those numbers that are generally consistent with recessions resulting from unemployment. So what he was saying in a nutshell is the U.S. needs a sustained period of below-trend growth and a softening of the labor markets. So now that we know that the Fed needs to soften up the labor market, and we also know that any wage increase that we have been seeing has just been getting chewed up basically by the inflation, he went and basically started tackling and discussing supply and demand. Because right now we do know that demand is way outpacing the amount of supply that's here in the US, and that is the deal. The definition really of inflation is there's too many dollars out there to be able to buy up too little products, and that's what he is trying to correct. So as he was saying this, he basically said any delay in their aggressiveness moving forward with the federal funds rate will just lead to more pain. So what we can expect out of the Fed is for them to continue to get aggressive throughout this year and into 2023.
Interest rates favor a recession. 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward-looking and the lags in your policy are forward-looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below.
So with the Fed needing a period of below trend growth and a softening of the labor market, can they really come in for a soft landing at this point?
Chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer.
So there, essentially, you have it out of the horse's mouth. Are they going to be able to come in with a soft landing? During his press conference, he said specifically that the Fed will have to get more aggressive, and he also said that they'll have to do it for a longer period of time. So, are we going to come in for a soft landing? Honestly, the question to that is already answered. I don't believe it's possible. At this point, I believe that a recession is going to hit. And as the effects of the recession hit, they do need to soften their policy in order to have the economy get back on its feet. And in the housing market, when it comes down to mortgage interest rates, what happens historically when the effects of a recession hit? The mortgage rates will come back down.
Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week, and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset, and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues though with the housing market, as you know, where it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
Housing reset. Well, let's go ahead and let's see how maybe the Fed here in just a second could be able to continue this maybe downward slide in the housing market. But let's take a look at the Treasure Valley and let's talk about, yes, was it red hot? Absolutely. Over the last couple of years, really until about April of 21, where things started to kind of level off. And then we went up again, this year a bit before our actual market correction hit, which was about between late May and early June as to when the top of the market was. Now, we do know, if you do watch Mikey's monthly market updates, that our market correction here in Ada County has came down a little bit over 6%. And in Canyon County, the home values have came down, the median home values have came down a little bit over 7%. So are we in a market correction currently? Yes, we are. And is what Powell's saying, in terms of, for builders being able to get their supplies, their supply chains, and be able to get it for, relatively cheap costs like it was before they started getting aggressive with the federal funds rate. Yeah, that's here. It is becoming harder for them. But I'm not going to blame it so much on zoning and finding land, especially, right here in the Treasure Valley, as much as I would lay it at the feet of the federal funds rate and where the Fed and how aggressive they are being with it, which is really kind of hurting, especially smaller builders here in the Treasure Valley from doing their job and creating more inventory. So let's talk about that housing reset here real quick and kind of dive into that. What kind of power really does the Fed have to be able to continue maybe downward slopes in prices in this market correction that we are seeing right here in the Treasure Valley? Well, really, that comes down to their balance sheet. What a lot of people don't know is that what really kept mortgage interest rates as low as they were for as long as they were is that the Fed was investing pretty much heavily into mortgage-backed securities in order to more or less float the economy and, again, keep those interest rates low. So what do we know now? We do know that the Fed is deciding to go ahead and start to dump their balance sheet. Or they really kind of today in some articles that I've read, especially back September 16th, just a few days back, is that the Fed really has kind of stopped buying the mortgage-backed securities. So now, if they start selling them off, that's basically going to go ahead and dump the overall value, okay, of the mortgage-backed security, which we know that when the value goes down on mortgage-backed securities, we know that interest rates go up. And if interest rates continue to be on the rise, that could also push out a lot of the buyer pool and continue this market correction going. But as we've seen, though, we have seen signs of stabilization happening right here in Canyon County. And I anticipate, especially if you watch Mikey's monthly market updates, for Ada County to follow shortly after that. So we'll just have to keep watching, stay tuned, and see what the Fed decides to do. But in this clip that I'm going to show you here in a second, the Fed also did say that they do not plan on selling their mortgage-backed securities anytime soon.
The balance sheet, you all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now and not something I expect to be considering in the near term. It's just, it's something I think we will turn to, but the time for turning to it has not come and is not close.
So there we basically have it. Nice journalism, CNN reporter. CNN, what can you say? So either way, as we kind of see the housing market going along right now, is this going to be really a bad time to buy if you're out there actually shopping and you're looking to do so? As I've said in prior videos, no, it's not a bad time to buy. And here is why. It's because honestly, the inventory is up. Buyers' demand is down. So what does that mean for you buyers? That means that if you want to actually get the home of your dreams without a fight that we had, say, a couple of years ago when the housing market was red hot, like Jerome Powell said, you really can. You can go out there and find that. We also know that we've returned to a buyer's market right here in the Treasure Valley, which means that price reductions are happening all over active listings out here, which, is creating this market correction that we have been seeing. So not only can you get your home for cheaper right now, but also we could probably continue to negotiate to get the home for even cheaper. Also, concessions have returned. And what are concessions? Basically picking up things like your closing costs or to buy down the rate or whatever it is that you basically want to do with the concessions that a seller may be offering you in order to entice you to buy their home. So buyers, this is a good time. And we do know, okay, based upon this data that basically the Fed had came out and said today that they're going to get more aggressive and they're going to have to do it longer, which is going to usher in the effects of this recession. I don't see any way of them staving it off at this point. So not only did you get the home of your dreams that you were looking for, but then you can go ahead and refinance for practically nothing or free once the effects of the recession hit and the rates go back down. Now, do I see rates ever really kind of going back into the threes again like they were for so long? Honestly, my honest opinion, and if I was a betting man, I would say that they would stay between 4 and 5 or maybe even the low 5s as going to be that kind of new normal to expect. So buyers, just kind of keep that in mind as you go along. So in summary, basically, what did we learn from the Fed meeting today? Is that they have to get more aggressive and they have to probably do it for longer.
My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We will keep at it until we're confident the job is done.
The Fed today very easily could have went up 1 point instead of 0.75 like they did. In fact, actually, the SEP was anticipating that, or they're anticipating that the federal funds rate will be at 4.4% by year's end. So if they actually went up a full point instead of 0.75 today, honestly, they would have been more towards that goal. But if you're asking a lot of economists out there whether or not the Fed is really behind in terms of where the federal funds rate is right now to combat inflation, a lot of those economists are going to say, yeah, there's a lot of economists that think the federal funds rate right now should be sitting between 5 and 7%. And honestly, I can't personally disagree with them in order to be able to combat inflation, because we know we just can't keep printing money. And unfortunately, our administration is doing that.
Come on, man.
Inflation reduction bill? Yeah, I don't think so. More or less inflation continuing bill. So honestly, our government just has to stop printing and spending money in order to kind of, correct this and help the Fed. But really the Fed, again, in my honest opinion, is kind of behind the 8 ball a little bit, and they do need to get more aggressive. So now I just want to end with this. Does the federal funds rate really hurt mortgage interest rates, or is it closely correlated? And the answer to that question is no. The federal funds rate usually is just going to affect, is going to be the biggest weapon versus small term bonds, okay, or small length of bonds, okay. It's like to say to a 10-year treasury yield or a 2-year treasury yield. The 2-year treasury yield is going to be more affected than say the 10-year would, okay. But even though the 10-year still kind of feels some ripples from the federal funds rate. Now, the treasuries, especially the 10-year treasury, we know that mortgage-backed securities does generally kind of follow the trend of the yields that happen with the 10-year treasury. But at the same time, mortgage-backed securities are separate, and mortgage-backed securities can actually be considered, more of a short term. So the federal funds rate, though, is still kind of distanced itself. But if the Fed does have any general power that could come up to affect mortgage interest rates is if they sell and start selling off their mortgage-backed securities. So we are just going to have to wait and see. Well, thank you very much, everybody, for taking the time out of your day to watch this video. I hope that you found all this information useful. And of course, if you're looking to buy, sell, or invest right here in the Treasure Valley, feel free to reach out to me today. I can be reached at 208-715-STAR. Again, that's 208-715-7827. And if you're looking to begin your home shopping experience today, please feel free to visit my website at www.yourstarrealtor.com. Also, if you're thinking moving in from out of state, click in the description below, download my free relocation guide, so that way you're in the know before you decide to make the move. And lastly, please hit that subscribe button below, please, and click the notification bell so that you're constantly in tune with the videos that I do come up with. And comment, please. Would love to hear your thoughts on what do you think is going to happen, coming up. So thanks again very much, everybody. I look for the day we speak. I look for the day I call you my neighbor. God bless. Until then, thank you so much. Bye-bye.